Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the Cash Flow Memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
To start Exhibit C is hugely impacted by activity in Iran. I believe that the supply and demand on 26, once things get sorted out in Iran, is not going to change a whole heck of a lot. Iran here is exporting a fair amount of oil, a little bit less than last year, but despite all the hostilities, Iran is still loading tankers that go through the Straits of Hormuz and onto China. Their production is holding up better than the other people in the Persian Gulf. The use is going to be impacted by the price, but as we go to Exhibit V, especially if the Iran activity starts to phase down over the next few days, you could see last Thursday, the price had increased to 77 in the prompt month and 65 and 27. That prompt month now, I think, is up in the mid 80s, and 27 is probably a few bucks more than 65. I think from an investment point of view, the price to keep an eye on is that futures price. Will it go all the way back to $60 or $62 or whatever it was before Iran and Israel and the United States, in effect, went to war? I don't know it'll go all the way back to the low 60s, but I don't think it's going to maintain anything like 70, despite all the really historic activity. I mean, the Straits of Hormuz, carrying 20% of the world's oil production, has never been closed, and everyone always speculated on what would happen if it were closed. Now I guess we know. I think if things phase down, I think what we'll have is kind of a ceasefire, kind of like after the 12-day war last June. There won't be any peace treaty or anything like that, but ships will be allowed to pass through the Straits of Hormuz. There won't be mines. There won't be drones chasing the ships. The U.S. will cease operations over Iran, except possibly for surveillance. Same thing as Israel. And we get out a few more weeks and it'll be old news. In the meantime, natural gas has benefited a bit here because Qatar is 20% of the LNG production in the world. They had no tank capacity, shut in its LNG trains and shut in its gas production. And they have said it'll take 30, 45, 60 days for them to bring that on. So the price of LNG, spot price of LNG going into Europe increased from $8 or $9 an MMBTU before the war started to, I think it peaked at over 20, and it's now back down in the high teens. So I think that will come down to, I don't think it'll go all the way back to $8 or $9 or wherever it was before the war started, but I don't think it'll hold too much higher than $10 or $11. That will help U.S. gas pricing, but the main problem with U.S. gas pricing is the supply. We have 108.5 dry gas production, and for 26, well, we're already at 108, 109 now, and it's only March. So the problem is the production, and the problem is the Permian, as you can see from that table, second table on Exhibit B. The production increase in dry gas from 21 to 25 was 15 Bs a day, and 2/3 of it was Permian, which is associated gas. So it's odd. To the extent oil price outlook looks better, it means more gas. And in fact, the Waha hub, which is where gas is traded in West Texas, has been negative the whole time, sometimes by as much as a -$4. I think that dry gas production of 108, I think it's going to average at least the number predicted here for 26. So the good news is LNG's pretty building well, and there's another facility that's taken a long time to come on called Golden Pass, which is, when it's fully up, it'll be 2.5 Bs a day. So I think that 17.5 estimate for 26 is pretty secure. That may be conservative. The problem is power. Power has stopped growing despite all the commentary on data center demand, power demand. Gas to make power is still pretty darn flat in the statistics. Exhibit A, cash flow statement for the U.S. government. I think that it'll be, the estimate here for excise taxes at 600. And I noticed my page is cut off. If everyone's page is cut off, I apologize. But I think it will. I think that will be secure. I think they're going to have at least enough tariff revenue, and I do believe the fiscal year we're in will be $1.5 trillion down from 1.9, and that'll be real progress. In fact, during this period of time, the dollar has strengthened. I guess viewed as being a haven currency, and there's less talk of central banks abandoning U.S. government securities and putting their money in gold. So I think that's another thing that we can expect. And as the war wears off and it becomes clear that we are making real progress on our deficit, I think that will tend to have people be more inclined to hold dollars or U.S. government bonds, paying dollars. With that, the update to December 25 financials, page 1 are done. Apple, Amazon, Alphabet, Microsoft, Tesla all had pretty good years. The main thing with the update and the numbers based on, we update these every quarter based on September, is the massive increase in capital spending. Look at it this way. Amazon has EBITDA, in other words, cash flow before capital spending, of about $150 billion on a little more than 700 billion of revenues. That's remarkable. I mean, a lot of the revenues are, relatively low margin. I mean, basically, they're selling on the Amazon system third-party products that they purchase or they represent, but then they have higher margin revenues like Amazon Web Services and advertising and whatnot. But to have a company like Amazon with 700 billion of revenues with 150 billion of EBITDA, cash flow before capex, is remarkable. And they only pay $10 billion of income tax, but their capex is huge. It's 132 billion. Their R&D spending is 100 billion. They're really investing a lot. So the free cash flow, in other words, the amount that you could pay out as dividends, is only $8 billion. Now, Amazon equity trades for 2.3 trillion. So that's, huge multiples on free cash flow. I think the expectation is that all that capital spending in R&D will result in a company that will do more revenue and have more cash flow before R&D and capex. But it is a remarkably large amount to reinvest. When you measure investment attractiveness across the page, Apple spends practically nothing in capex, about 10 billion. Alphabet spends 90. Microsoft spends 90. Alphabet and Microsoft have free cash flow. If you're trying to pick as, which investment do you want to hold? I mean, Tesla's kind of in a class of their own because their equity at $1.5 trillion is gigantic compared to their revenues, which is 95 billion, or their free cash flow of 6 billion, or their pre-capex cash flow of 14 billion. There, you're paying for the prospects for robotaxi, a robot program, and a lot of blue sky. But if you take those four more mature companies, you necessarily immediately gravitate to Apple because they have 115 billion of free cash flow because they only have 10 billion in capital spending. Do you decide that you want to swap your Amazon stock for Apple, or you prefer Alphabet or Microsoft? My own view is all of these four companies are remarkable performers. They are really the best companies in the world. And you have to include Amazon because they have a history of doing this over their history. If the others, like Alphabet's trading for almost 4 trillion, Apple's trading for almost 4 trillion, Microsoft is trading for 3 trillion. Would Amazon, if they spent less capital spending and less R&D, trade for closer to 4 trillion than 2 trillion? Yes, but if you're looking at this from a 5-year investment perspective or a 10-year investment perspective, is it the right thing to avoid Amazon and own the other three? I don't think so. I am a total devotee of having lots of free cash flow, but I think Amazon's record, starting with just doing books, is quite remarkable. I mean, despite the high capital spending and the high R&D, you shouldn't run to the others and abandon Amazon. Towards that end, if you turn to page 8, and for those who don't have the 20 pages in front of you, I'll talk you through this, but in a very real extent, Amazon's competitor for its non-data center business, for the other businesses they do, is Walmart. And Walmart has about the same level of sales, 710 billion. Walmart will deliver now. They certainly have pickup. They are a formidable competitor to Amazon. Their free cash flow is 28 billion. Another way to look at it, their cash flow before CapEx is 50, as compared to 150 at Amazon, same amount of sales. So now Amazon are the largest in data centers, and so they have a big contribution of cash flow from Amazon Web Services as compared to its contribution to revenue. But the valuation of Walmart is just under $1 trillion, $900 billion. Its ratio times cash flow is around 34 times. I think people look at Amazon and they say, 2/3 of Amazon is kind of competitive with Walmart. The other third is Amazon Web Services, other higher margin business. If we turn back to page 1, Amazon with an equity value of 2.3 trillion, you could say about $1 trillion is for the retail business that's competitive with Walmart, and something in excess of $1 trillion is for Amazon for the data center business. And I think that's about right. Mike and Jason, what do you think about my pulling Amazon valuation apart? How does that look to you?
I think when you think about it as two separate businesses, I think that's right. But it also has a bit of the other bets situation that Google has as well. One of the things that just came out this week actually is news about their self-driving car project called Zoox. They're expanding their operations in Arizona. So that whole robotaxi business, it's not just Tesla and Google.
Yeah.
My point was about Apple and their current free cash flow. And it'll be interesting to see how that changes when they finally do release a version of Siri that's powered by real AI and useful. Either they're going to greatly spend on building AI data centers, or their OpEx budget that they presumably pay to Google is going to increase greatly.
Okay, now I'm going to make another distinction, see if Mike and Jason, see if I can sell this idea to them. And then we've got plenty of time. We'll do healthcare after that. In looking at these four companies, plus Walmart, plus Nvidia, I'm purposely met out for a second. Seems to me Apple's got a weak position or things to be concerned about. And Jason nailed one of them, which is they've got to have Siri work better. And that may cause more R&D, more CapEx. But the other one is the exposure of making, they are basically a hardware company, and the hardware largely comes from China. I mean, I think now they're making maybe a third of their iPhones in India, but still has that exposure. Alphabet has a bit of exposure, which is they have the most profitable business in the world in search. And they've had to pick up their performance in language models and whatnot to defend their search business, their search franchise. And even though they seem to have done quite a good job, I mean, it was a $150 stock halfway through last year, and it wound it up at 300. Excellent performance, but still that people use the language model apps and don't use search as much, since search is entirely supported by advertising, is still a vulnerability with Alphabet. But without getting comment on that, I want to turn to page 3 and Nvidia. In terms of revenue, nothing competes, or bringing revenue down to cash flow, nothing competes with Nvidia. Here, this is a snapshot of how Nvidia looked. The snapshot, there's going to be more revenue and more cash flow when this is updated for their year-end results. But based on how it looked at the September quarter, 200 billion of revenues, and very little capex, only 6 billion of capex, but 200 billion of revenues, 100 billion of free cash flow. Just remarkable cash flow performance. So, I mean, if Apple's vulnerability is they just haven't been able to upgrade Siri, and they make an awful lot of their hardware in China and India. And if Google's vulnerability is they did a great job of protecting the search cash flow, but search is advertising. It depends on how much people are using it. So some vulnerability there. Nvidia's vulnerability would be, those are incredible margins to earn. And so if you're looking for safety, you might gravitate towards Microsoft with maybe a more defensible cash flow moat, or a more defensible moat on their cash flow and their Office and Windows businesses. However, of course, Microsoft has lagged a bit. To people with Office programs, are they using Copilot? Probably not. Probably they're off using one of the Claude apps or a Gemini app or whatnot. So I guess these are marvelous companies. There's this theory that these companies have had their run. The best thing to own in the next 5 years is, or something like 5 years, more diverse group of companies. These are very, very strong companies, but they do have their vulnerability. As we talk through them, they all have vulnerability. I'm reminded of Andy Grove, who was one who really drove the success at Intel, wrote a biography, and the biography was subtitled, "Only the Paranoid Survive." And I think, given how strong these companies are, if you talk to the CEOs or the founders or the prime movers in these companies, they would probably agree with Andy Grove's sentiment, what you have to do to be able to succeed in this industry.
Absolutely. I think in technology, the most underappreciated and most important moat one can have is the ability to iterate at a very fast pace and make improvements over time. It's what enabled us to identify that Intel had fallen behind. It's what's enabled us to identify that Nvidia has a fairly sustainable moat because of how far ahead they are with the others. I think Microsoft is a little different because the service they provide their customers is a trusted technology partner. So those same customers that are giving their employees Copilot, maybe the employees don't like Copilot as much as some of the others. The reality is that employer views the risk of their employees using other stuff as higher than the gains from having the latest, greatest thing. Different things for different companies, but I agree with you. It's hard to deny that artificial intelligence is, for most all of these, a sustaining innovation that will benefit the incumbents.
Yep. Jason, we turned to page 15. I don't know how many people noticed, but I'm a big fan of Biotech and Moderna on these pages. Biotech's done a much better job of hanging on to their cash. They both benefit enormously, of course, from the COVID vaccines. But the two founders of Biotech resigned and apparently are going to set up a new business that's going to be in competition with Biotech. No way to anticipate something like this happening, Jason, is there? Or can you think of other instances in the healthcare industry where the founders and large stockholders get crossways with their fellow board members and decide to stay active in the business, but resign and go into competition with the business they founded?
Yeah, it's definitely very unusual. I would be interested to see what types of products they ultimately end up researching. We have a friend that likes to say early stage founders, some of them have a gift at doing the deadlift. And that's starting the company and doing the early startup phase and letting professional managers run it from there. I'm not saying that they're not professional managers, but it feels like this is kind of a case of that, where the husband and wife founder team is really interested in the early stage mRNA research, and they want to be on the cutting edge. And the fact is, Biotech as a business has kind of changed. They have a lot of their pipeline in late stage research, which is a lot of managing clinical trials, managing the consultants you pay to run the trials, dealing with regulatory and FDA issues. And then the next challenge is commercialization, which they haven't even got to yet. So there's a long runway ahead for Biotech that does not involve early stage research. And I wonder if they just have grown tired of kind of that phase of the company and they want to get back to the early stage research. One thing that we look at in biopharma as the most important aspect of analyzing the companies is their capital allocation. I'm really kind of a fan of this decision. If those two people are the best at early stage research and at running those programs at the business, put them back in that position. And then in this case, you're spinning off the early research where you're seeding it with some IP and taking a minority stake in the business. But what you don't have to do is fund a decade of preclinical and clinical research that it's going to take to find out if these early stage projects actually work.
Yeah, Jason hit the nail on the head. It is the way too common that you see an early stage biopharma founder get a product commercialized and then immediately want to take that cash flow and put it back into whichever super early stage pet project they have. The reality is those businesses, if they're started separately and funded by not just the main corporation, if they have other VCs invested in it, for example, you'll have some level of validation that lets you know that you're not just throwing good money after bad. And I think that's something we see in some of the largest pharmaceutical companies. Pfizer, for example, look at that R&D budget. They spend $10 billion a year, which actually fits our model. They're doing $19 billion in cash flow, spending less than half their cash flow. But some of the others are not nearly as efficient. Then you look at Vertex. Vertex is spending 3.9. They're doing 3.8 in cash flow, and the pipeline is quite amazing. One thing to point out about Vertex, Joshua Boger, the founder of that company, if you read the books and the history of it, he was very intent on building Vertex into an R&D engine. He did not have a pet science in particular. He wanted to build a research process that could design a molecule to solve a problem. And that's his lasting impression on the company. I don't know beyond the co-founders of Biotech that what their contribution is beyond being experts in mRNA. And how they, whether it was them or the board that made the rational decision to partner on the distribution of their COVID vaccines. I mean, that's really what's made the difference between them and Moderna.
Yeah. I mean, Moderna had to do it all, where BioNTech joined up with Pfizer, and Pfizer made the medicine and distributed it and whatnot. So, yeah, sounds kind of constructive. But, Vertex is on its third CEO, and they seem to be able to maintain that commitment that its founder had. So that's very impressive. The other one that Mike and Jason are very involved in is Harrow. I think that Harrow had its results and disappointed with the low projection for the coming year. But I think Mike and Jason are as interested or as convinced that Harrow is on the right track as when they first began to do their research on Harrow. But over to the two of you.
Yeah, nothing in our thesis changed other than and they were extremely candid about it, that they're going to be much more conservative in their guidance. The CEO spoke at a conference, I believe just yesterday. If you're interested in Harrow or currently own it, that would be a good thing to listen to. The business sounds like it's running extremely well. It's on track. Nothing has changed, and kind of separate from the way the stock chart looks.
Yeah, those are the situations where when the price goes down and you're a long-term holder like us, you don't really care. I mean, yes, it'll impact us on a quarterly return or whatever, but we think as long as something fundamental hasn't changed with the business, we're happy to wait until the market figures it out.
Yeah. Just in closing, you separately made a prediction on something probably connected with AI, certainly in the technology companies, that will happen in the next 30 days. That will be quite a surprise to everyone's. What did you predict? Or what? I mean, since I'm asking you a question, you need a couple of minutes to gather your thoughts. I think there's a chance that Anthropic is able to just win and develop some kind of a moat by just releasing apps that people like and want to use, and so that their growth in revenue outdoes OpenAI and Grok. Whether that turns into something that approaches the Office monopoly for Microsoft or the search monopoly for Alphabet, I wouldn't make that claim. But I do think they've demonstrated that they're just better at coming up with apps that don't have bugs in them and that people find very attractive. And I think they will continue to do that. I mean, the conventional wisdom is that these models are commodities, but I'm not sure the apps are. But Mike, Jason, over to both of you. What would you predict that will be unexpected?
So what would be unexpected would be XAI releases a new model that is easily more advanced than the others. It'll be the first Blackwell trained. And I think there's a good probability they'll release one. The question is whether it will be significantly better. At the point that you're making, though, is right, is Claude Code in particular, which I guess you could say is sort of an app. Basically, it's an AI model with the ability to plan and execute and write code and then Cloud Cowork being an app that can do a bunch of stuff on your computer. That is the direction we're going with these things. And it is likely that the model providers will start doing more of that. The challenge is everybody had the capability of releasing this open source product called OpenClaw, which you can get now. Nobody wanted the liability associated with it because if not handled well, you can very easily delete a bunch of sensitive information. At worst, it could be a lot worse.
Yeah.
So it does require some technical capability, and I don't think there is appetite for any of these guys to put them in themselves in a position where they release a product that people are really appalled with.
Right.
So my prediction was going to be the opposite of that. I think that Microsoft has not innovated on their Copilot project in a while. And with this partnership with Anthropic, that has to have been in the works for quite some time. And Claude Code had the ability to be OpenClaw, essentially. It's just Claude Code with a scheduling component. I think that they're going to release a Copilot that is an agent that does work, and it runs entirely within the Microsoft, Windows, Office ecosystem. And they've built those guardrails around it.
Yeah, I think we may have a new operating system race. And I think the incentive for Microsoft is to tie it to the cloud, but maybe not. Maybe there's a new Windows as well.
Right. Good. Well, I think we more than made up for our delay. In the meantime, please enjoy the weather in the Northeast. The last 3 days, we've had better weather than San Diego, which never happens in March. And we'll be here exactly 7 days from now. And everyone be well and stay healthy. Thanks very much for listening. Take care.
The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to and no reliance should be placed on the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.